Good morning. I know I'm the last presenter before lunch, and I work for what's ultimately a Swiss organization, so I am committed to ending on time and getting you guys to lunch. For those of you who don't know, the World Economic Forum is an international Swiss organization for public-private collaboration, and we're best known for the annual meeting that we have every year in Davos. And sometimes people ask me, what do you guys do when you're not in Davos? And the answer is that we're working on bringing together members of the innovation sphere, members of large corporates, government, and others to try and really solve and understand some of the really interesting problems that exist out in the world. And so in 2014, we brought together in Davos a group of 50 senior financial services leaders, banking, insurance, and asset management. And we asked them, we're seeing all of this new stuff on the horizon. What do you think FinTech means for the future of financial services? And the answer was agreement across the board. Banks versus FinTechs? No contest. We are not worried about this at all, because at the end of the day, incumbent FIs have scale, they have trust, and more than anything, they have enormous regulatory complexity that they have to deal with. In a sense, I feel like I've never seen a group of bankers talk so fondly about the regulator. But okay, we came back a year later, because I think it's really interesting to see the way that this has changed. The first Exponential Finance event, I went to it. It was just a couple of months after we had this discussion. And when we reconvened in 2015, the story was completely different. The banks were worried. They were jittery. They were concerned about what exactly it was that FinTech meant. They saw that there was the potential for FinTech players to skim the cream from their operations. This wasn't like the direct banks of the 90s that were attempting to replicate the whole of what they did. No, it was different, and they weren't sure necessarily how to respond. And then we reconvened that same group again this year in Davos, and the discussion had evolved yet again. There was almost now a little bit of swagger. People felt like they had figured out the solution. And it's exactly what you've been hearing about over the last couple of panels. It was about partnership. It was about collaboration. It was about working together. And there was a view that this wasn't just a threat to financial services, though it was that. But there was more to it. There was the opportunity, as it says here, to fix financial services. But let's take a step back, because FinTech is complicated. And when we first started this project, we went out and we talked to the chief strategy officers of almost every one of the 80 financial institutions that we work with. And they said to me, I feel like FinTech is random acts of violence. Innovation coming from all angles, and I can't figure out what's smoke and what's fire. And we thought, okay, well, the World Economic Forum, we're connected to all of the participants that you would need to maybe get an answer, or at least, if not an answer, a better understanding of what's happening in FinTech. So working with Deloitte as our professional services partner, we went out and we ran a 15-month process to really try and understand this. And we knew that we couldn't just talk to the industry incumbents, though we were connected at the very highest level there. And we reached out to bankers, insurers, asset managers, and others to understand. But we also went out and talked to well over 100 CEOs and founders of leading FinTech companies, the people who were out there trying new things, trying to reshape and redefine the structure. And most importantly, we didn't just talk to them, interview them, do background research, but we brought them together in workshops around the world where we took relatively equal numbers of those strategy officers and those founders of FinTechs and put them in a room and effectively asked them to fight it out over their conflicting and contrasting versions of the future. And as I think my earlier slide suggested, they often found that they actually were closer to being on the same page than they had necessarily expected before we brought them together. And the result of this work was a consolidated framework, a taxonomy, if you will, of innovation in financial services that focused on 11 clusters of innovation and did deep dives into understanding what are the innovations driving these, but also what are scenarios for the evolution of those ecosystems and what are the implications for incumbent FIs, for FinTechs, for customers, regulators, and others. And that consists a 178-page deck that's available online and that anyone can go and read. And I'm sure that you'll all go and read it cover to cover. But I'm trying to get you to lunch, so I'm not going to necessarily go through every one of those clusters or every one of those pieces. Instead, what I want to do today is three things. I want to talk about what are the cross-cutting trends that we observed around fintech firms that were succeeding in this space. Secondly, I want to talk to you about what the future might look like. Are we thinking big enough, as the presentation title says? What might the future look like? And then thirdly, I want to talk a little bit about the insights that came from Davos this year and how we're seeing large FIs and fintechs working together to maybe fix financial services. So firstly, 4 observations on fintech as we see it today. And the first and most important one, I think, is that fintech isn't random at all. Fintech is a deliberate and predictable process, and it's occurring at the intersection of where customers, be those retail or wholesale, are experiencing frictions and frustrations, and where the existing providers are continuing to be profitable. And I think one of the most illustrative examples of this is TransferWise. International remittance is a terrible process, particularly as a retail consumer. You don't have visibility into the fees, you don't know how long it'll take, you don't really know where your money is between endpoint and endpoint, and it's really expensive. TransferWise figured out a way, actually in some senses a rather simple and elegant way, of delivering that service for low denomination customers at a lower cost, and then they wrapped a great mobile customer experience around it. And now they're rapidly expanding outside of their initial home of the EU. They're here in New York, they're in Canada, and they're transferring over $750 million a month in this, via this app. Still small numbers relative to the size of the total financial system, but I think really illustrative of how people are solving these niche problems. The second thing that we saw was the business models that successful fintechs were using. And I think it is an incredibly overused cliche to say that something is the Uber or the Airbnb of something else. But it is doubtless the case that platform-based models have been instructive to many other industries. And so when you look at the marketplace lenders, when you look at the Roboadvisors, when you look at the crowdfunding platforms, they've all taken a lesson from Uber and Airbnb that if you get the right model and you can attract the customers, it gives you the opportunity to very rapidly scale up, and in particular to move up your revenues, your AUMs, your origination, whatever your key metric is, while keeping your costs rather flat or only growing arithmetically. And so that means that it doesn't always work, but when it does work, it becomes big in a hurry. The third, and I think maybe a little bit non-obvious point that you get around fintech, is that the very focused approach that's being taken by these firms means that they're leaving some activities on the table. As I said before, they're not the direct banks of the 1990s. Instead, what we're seeing is that as first movers in the space, fintech companies are making aggressive and strategic choices about where they want to compete and where they want to piggyback on legacy infrastructure or incumbent services. And I think the best example of that is a company that you might not think of as a fintech. It's Apple. What is Apple good at? Apple's good at delivering fantastic user experience on a mobile platform. They've been doing it since they came out with the first iPhone. And they're also fantastic at having iPhones in everyone's hand. So they have scale. And so they didn't take the route that many had tried to take before to do a wholesale disruption of the retail card payment system. Instead, they said, let's just focus on the things that we're good at. Let's create a great payment experience on our phone that we own and control. And they used that as leverage to wedge their way into the infrastructure of payments. I think you can see the same thing in some of the discussions that you heard about earlier around these robo-advisors. People understanding that really the advantages that they have are around generating a wealth experience that resonates with people, not necessarily always about building complex financial products or about onboarding users, that in fact they want to, wherever possible, leverage the capabilities of incumbents. And then fourth, and I think really important, is that if you read the papers, you could be forgiven for thinking that FinTech is a consumer phenomenon. Marketplace lending, crowdfunding, all of the financial inclusion stuff, it's really exciting and it's sexy, but there's also a revolution happening on the back end. They're changing the way in which banks and insurers and asset managers are being run. And two of my favorite examples of that are up here on this slide. Fund apps does something that you might consider very boring. They help funds manage their regulatory holding disclosures. And so if you're making investments in a Mongolian yak dairy, you need to know whether or not what the holding limits are from the Mongolian Stock Exchange on when you need to sort of disclose that you hold maybe 10%. But if you're a small or a mid-sized fund, it's really difficult to keep a global and up-to-date record of all of that. So Fund Apps does it for you. It's part of an emerging field that's being called RegTech, that's allowing you to externalize some of the value unadding components of regulatory compliance. Kensho, really interesting. They're working on automating the process of quantitative analytics. And so when you go out and you ask yourself, I need to know if oil drops by another $10, what does that mean for Chinese GDP next year? There's a natural language model in Kensho that lets you sort of understand in a few seconds, rather than after 8 hours of an analyst's work, what the model's answer to that question is. And so great, these are trends, they're interesting, hopefully helping you think about FinTech in a little bit more of a structured fashion, but what you really want to know is what does the future look like? And I don't have a crystal ball. I think that's really important to say up front, but my team and I, we've been working a lot on thinking about what some scenarios for the future are. So these aren't predictions, but they're stories about how the future of financial services could evolve. The first one is about scale. And so when you think about the emergence of companies like Fund Apps and Kensho, when you think about effectively what is financial services software as a service emerging, that's really shaking up the traditional benefits that very large incumbents have been able to lever out of their scale. And what it means is that small and mid-sized players are going to be able to go out and access a highly sophisticated and scalable suite of services that'll be, at the very least, table stakes and allow them to focus much more minutely on the areas that they're really good at. The other thing is that if you think a little bit further out about the way that the emergence of cloud computing allowed second-wave internet companies to emerge without the need to hire a person who knew how to rack their own servers, you could see a similar thing here. A base of subscription-based financial competencies that can be accessed by new fintechs to rapidly, much more rapidly than we see today, stand up new apps. The second scenario is an even more fundamentally disruptive one. And today, if you think about the retail universal banking experience, a huge part of that experience is predicated on the fact that there are an enormous amount of frictions around owning 5 different financial products with 5 different providers. There's a sense in which the incumbents have a big advantage because they're able to put everything for you in one place. But what if in the future that wasn't true? What if, as more and more fintechs develop, connective tissue begins to emerge between them that facilitates greater levels of interoperability? And we see this to a degree already with players like Alibaba and Tencent. And my view is that it's likely to continue to emerge and mature. And this would be a really interesting thing for customers, because what we've seen over the last 10 and 15 years is an enormous amount of effort by financial institutions and a huge amount of money put into building customer-centric services. But the reality is if we're honest with ourselves, those have not met expectations. Most financial institutions today would confess that they're still inherently product-centric institutions. And there's an interesting inherent advantage of a platform, an Amazon for financial services, if you will, that lets you shop and cross-compare for different sort of products, that maybe even provides you recommendations, is that it can focus exclusively on creating a customer-centric experience while leaving others the job of creating best-of-breed and highly competitive financial products. The third item that we've thought a lot about is risk metrics. Think about FICO today. It's really based on two things. About 70% of your FICO score is based on your use of available credit facilities and your repayment of those credit facilities. But in the future, we're going to see more and more fracturing of those credit facilities. And we're going to see more and more fracturing of the payment experience as well. It's going to make it more and more difficult for traditional players to pull together the right information in those FICO scores. At the same time, you're seeing already today all sorts of people asking themselves, well, how can I know better things about your creditworthiness based on your social media behavior, based on data that I can get you to link over to me on an API that is really going to potentially allow people to make better choices, and that's going to risk an adverse selection for those people who are still reliant exclusively on old mechanisms. And this isn't to say that FICO won't still be important or that those metrics won't be important in the future, but it is to say that they may be insufficient and that leveraging them alone could constitute a serious competitive disadvantage. Fourth, blockchain. And I know you've heard about blockchain a lot already today. I think it's clear today in a way that it wasn't 2 years ago to financial services executives around the world that blockchain has the potential to radically remap financial processes. And I think if you look across all sorts of verticals, whether it's proxy voting, it's insurance, whether it's asset settlement, all of these things we're talking about how is the blockchain going to really upend these processes. And in the process, it's going to question certain fundamental assumptions that are at the center of existing business models. But what we don't know today is that we really, in my opinion, don't know how this is going to unfold. It's really difficult to tell who the winners and losers are. And I think it's also important to realize that even though this technology exists, actually plugging into this technology, building new infrastructure, is a non-trivial task that requires extensive stakeholder integration, that requires regulatory engagement. And so these are the types of things that my team and I are actually thinking about right now for a series of use cases. What are the complications that exist on a business implementation level, and how are those going to shape the emergence of production-level blockchain implementations? Fourth, I think something that we don't talk about nearly enough, identity in financial services. And I think if you think about all of the things that are emerging today in financial services, and indeed if you think about financial services as a whole, every time you engage in a financial transaction, that transaction is predicated in a meaningful way, both for record keeping and for regulatory purposes, on your identity. But identity today continues to either be a physical instantiation or an electronification of a physical instantiation. This is an analog process. It creates enormous frustrations for customers. It creates huge expense for FIs in terms of KYC and AML compliance. There is a need today for a new identity system that is inherently digital. And increasingly, I'm coming to the belief that financial institutions and fintechs need to collaborate around the provision of that identity system and need to potentially think about acting as providers of identity as a service, guardians of your identity as well as your financial well-being in the future. And we're really excited to see how that's going to play out. And then finally, something I'm sure you've already heard a lot about today at this conference, the emergence of machine learning and artificial intelligence has begun the transformation of financial services. We work with one of our tech pioneers, a company in Silicon Valley called isnt, and they do all sorts of crazy stuff around mapping incredibly complex data sets in a topological and human-readable format. And what they've been able to do, working with a top 10 global bank on the administration of their CCAR processes, their comprehensive capital assessment and review, their stress test effectively administered by the Federal Reserve, is to take that from a process that took 300 individuals, analysts, data scientists, and others, and reduced it by 95% in terms of staffing, and took it from a 9-month process to a 3-month process, a complete sea change in how the bank ran that process. We're seeing other really interesting implementations here, like the use of AI networks to detect fraudulent or insider trading patterns. It's going to transform large parts of the financial business, and potentially the job of being a senior executive in financial services is going to transform in some meaningful way from the administration of teams of individuals pursuing an objective to the management of suites of services, in which those suites are composed both of AI systems as well as individuals and human experts working together. So I think at the end of the day, there were three sort of big questions that came out of Davos this year, because I think at the end of the day, we don't have answers yet to the future of financial services. But I think there are some big questions about the how of what we do next that financial institutions are asking themselves, and that'll be informative to the actions that they take in the future. And the first one is that incumbents very aware now that they can no longer rely on the regulator as a bulwark against new entrants into financial services. And certainly, someone said this year in one of our sessions, we don't want to become like the taxi and limousine commissions. And so I think this is really important because it's indicative in part of the fact that regulators have really started to become aware of the potential value of the innovation that's being driven in FinTech. There's been a realization across a large number of consumer and security regulators that I interact with globally that FinTech has the potential to drive competition, it has the potential to improve customer services and outcomes, and to ultimately have a more efficient system. And so what incumbents increasingly find themselves realizing that they need to do is thinking about how they can ensure that regulators maintain a level playing field for them to be trying new and exciting things as well, and in particular, that they leave open opportunities like the sandbox that was recently, the regulatory sandbox that was recently created in the UK for partnership between fintechs and incumbents around new and exciting financial products and services. And that takes us really cleanly into the next question, which is how can financial institutions become highly effective at partnering with each other and with innovative new entrants? And I think this is an incredibly important question. In our discussion in Davos this year, I had a very senior leader of a financial institution here in the US say to me, look, we understand that there's an enormous need for us to partner. We need to get access to that innovation that's out there, but we're not built to be an organization whose core competency is partnership. And so there's a need at a process level, at a governance and leadership level, and at a technology level to create an infrastructure and a culture that is allowing these large institutions to really mesh with new and exciting fintech ideas. And then the third, and I think increasingly one of the most important, is the idea that people play a really important role in this, and that in all of our discussion of all this whiz-bang cool technology, that you can sort of forget the importance of people. And there's been a lot of focus recently on job losses. Citibank put out a fantastic report recently that, amongst other things, calls for the potential that over the next 10 years, I think it was 2 or 2.5 million workers in financial services might find themselves redundant. And I don't in any way want to diminish the important social implications of this, and we need to think about what that means at a societal level. But we also need to think within institutions about how this is transforming our needs for the people who remain within the institution. And I think it's really important to see that it's not a one-to-one mechanism in which individuals are replaced by machines. The best chess players in the world today are not humans anymore. We know that from Deep Blue and Kasparov. But they're also not machines. Instead, they're actually teams of chess supercomputers like Deep Blue and chess experts, because they bring complementary skills to the table. The chess expert has honed over a long period of time a certain intuition about the board, in much the same way you can imagine an individual honing a set of instincts about the market. And people talk about trading on their gut, right? And there's something there. While at the same time, the machine is much better than the human will ever be at running correlations and all sorts of complex big data models to come up with new ideas. And so there's a sense in which it's not just about people potentially getting replaced in this process, but you actually need a different type of trader than you had before. One who can work with an intelligent system, to ask it the right questions, to synthesize interesting insights, and ultimately, hopefully, drive better outcomes for the institution and for its shareholders. And so, if I leave you with one thought, it's that it can be enormously tempting to treat innovation in financial services as a 2016 priority. We're gonna nail innovation this year, and then we're gonna move on to something else. But I would argue to you that there has been a fundamental change in the structure of the industry, an unleashing of innovation, if you will, that will itself set off subsequent waves of innovation that require financial institutions to become inherently more agile entities. And this means this is not going to be an easy transition, but those who are successful in it will better serve themselves and their shareholders, they'll better serve their customers, and they'll better fulfill the social license that we expect when we grant financial institutions as a society the ability to practice. So thank you so much for your attention. It's been a real pleasure chatting with you today.